Welcome to the weekly video update, where I'll go over the action in the market for the week of May 20th through the 24th, and then we'll see how things look for the week of May 28th through the 31st. Before I get started, I want you to be aware that where I'm residing these days is in Eastern Europe, and there's some geopolitical things happening, and that has caused an internet throttle down. And so I'm about 24 hours late posting the daily video. This is about 18 hours after I usually do the weekly video. I have three more videos to do after this. I don't know if I'm going to get those posted or not. I don't know if this is a temporary situation or if this is going to continue on for a while. So just bear with me on that. I try when I can to post any updates either in the private Facebook group or on the YouTube community tab. And sometimes I can't even get to that. So just be aware of those things. I try to have a real routine with how I post things every day and every week. That routine, in addition to the 3-day weekend, has been thrown out of whack right now. Okay, I want to wish everybody a happy Memorial Day. It's a very special day in the U.S. where we remember and honor the folks not only now, but ever since the beginning of America, who have either served or served the ultimate way by giving their life for our country. And this is a very special day. It's also the unofficial start of summer, and it's just a really good time to get together with friends, maybe have some barbecues. But behind all of that is just to commemorate the United States and the freedoms that we have. Okay, here are some notes that I want to go through first. I do post videos each day, and if you really want to know what's going on, I know they're longer. They've been about 40 minutes lately. I try to keep them at 30 minutes, but there's a lot of different things happening right now. Those are currently freely available until the first part of June, and I'll explain that here in just a moment. Also, I do have a program that I'm hoping to start in June. I don't know with this internet situation if it's going to delay those things. It has delayed things in the past, and it's kind of messed up my posting schedule. But if you want to learn more about the program, the bottom line is it's $97 a month. I have some videos on YouTube and Rumble that you can go through, which talks about what will be available in that program to see if that's something that may interest you. There's also going to be a very generous trial period, at least 30 days. And since I'm getting things off the ground, it may even be a little bit longer than that, as I work out the bugs and the kinks and so forth. There is a PDF available in every video that I post. It's in the description, either on YouTube or Rumble. I do have a new video that I just started doing in 2024 called What to Watch. This is where I really hone in on the things that I'm watching right now. I'm hoping I can get that prepared and uploaded before Tuesday's session. I also post each day pivot points, and they're on the YouTube community tab. There's a daily chart. Those pivot points last for the whole month and act as really good support or resistance areas. And then every day, there are intraday pivot points that I have found to be very helpful. I do have a private Facebook group. Now, if you look at the program and you're not really interested, but you still kind of want to stay in touch with me, maybe joining the private Facebook group might be for you. I thought about maybe doing away with this. But if you don't want to be in the program, you still want to maybe post something, ask me some questions, either leave a comment or send me an email. But you can also join the private Facebook group if you're even a member of Facebook. There's not a lot of activity going on, but hey, we get 1 or 2 people in there, and that could turn into an active group. So I'll kind of leave that up to you. I will be going through the poll results for the previous week. I haven't posted the new questions. I don't know if I'm going to be able to do that. And then the YouTube and Rumble comments, yeah, it must be happening again. I'm going through at least a couple of times every day on Rumble, and I have to delete these comments from these so-called SEO video digital marketing experts who went to some 30-minute webinar, and somebody told them, go into people's videos and start leaving comments. That's a great way to market yourself. I just delete those because I want that area to be for serious back and forth. If you disagree with something that I say or a conclusion that I make, fine. You're more than welcome to do that. If you want to keep it more private, right at the end of this video, I do have an email address where you can email me. And I do post on Rumble, and here is the link. It's also in the description below the YouTube video. And I think the YouTube video is below the Rumble. link. So anyway, all right, here's something about the program. I'm going to be locking down the daily videos on Monday, June 3rd. That's the plan right now. Now, if you still like the videos and you want to have free access to them, fine, you can do that, but it's going to be after the close for that particular day. So on Monday, June 3rd, the video for Monday, June 3rd will be available right when the market closes. I set a timer on that video to go from unlisted to public, and that's what happens. I don't even have to be around when that happens. So feel free, because about half of the people that watch the daily videos watch it after the market's closed. And that's fine if that's as far as you want to take it. If you want to have early access to the videos and you're not interested in being a member, which is $97 a month, you can pay $19 a month, which is less than $1 a day just for the daily videos. That's not including the work I put into the weekly videos. So, you know, you can pay that and you'll have access right when the videos are made available. The weekly videos are not going to change because my real focus is on the daily videos. So they're freely available whenever I'm able to get them ready and posted. If you want to talk to me about this, not only at the end of the video, but right here is an email address where you can email me directly and you can agree, disagree, provide your feedback, what have you. Okay, let me click through this here. Let's go back and talk about what happened this past week. We were up 0.03%, virtually unchanged, but it goes in the books as an up week. We were below average with volume. And ever since we've been coming up out of the lows in April, we've been seeing volume tapering off. Now, we saw it pick up a little bit on Thursday with the big down day that we saw, but even on that day, it just got back up to about average. And this is a longer-term negative divergence. Some people don't take volume into big consideration because there's a lot of different transactions that actually take place off of the exchanges that isn't counted as volume. So, yeah, all right, I can see the point in that, but we just have to use the information that we have. And lately, in the last year or so, as we've been going up and we're seeing volume increase, okay, that's been a confirmation. How come that's not happening now? There can't be a whole lot of transactions taking place elsewhere. So anyway, we are positive with our technicals. There's some warning signs that we need to be aware of. We're seeing a little bit more weakness coming into the daily charts. It really got strong after Thursday. But then we had a pretty good update on Friday, so some of that weakness is starting to get repaired a little bit. And we're seeing some of that in the weekly charts as well. Later on in the upcoming week, on Friday, we're going to get the core PCE. That's a big inflation report. The day before that, we're going to get the inflation component of the second reading of GDP. So we are going to get some inflation information this week, and that's going to have an impact on interest rates. We want to keep an eye on all the different geopolitical concerns, especially with a holiday weekend in the U.S., I hope. I haven't been able to really keep in touch because of the internet access problems here. I hope nothing really big has happened. Maybe it has, and I just don't know about it. I mean, who knows? But we just want to keep an ear and eye open for those things. So, crazy world in which we live. I'll show you this when I get to the chart, but we're still in a weakening trend. However, it's positive because the green line is above, but we're coming down with that green line a little bit here. So, okay, so here's some bullet points to take away for the week. The S&P and the NASDAQ. Now, earlier in the week, the S&P set an all-time high. We actually had an all-time intraday high on Thursday, but that was the high for the day, and we spent the rest of the day just tanking after that. But on Friday, the NASDAQ closed at an all-time high, and we barely had gains in the S&P. But the small caps and the Dow, they were down on the week. NVIDIA was the big topic, especially after Wednesday's close. Their earnings report just blew everybody out of the water. They announced a 10-for-1 stock split, and you couldn't have life any better than it is at NVIDIA right now. But the follow-through to the rest of the market, NVIDIA was up on Thursday, but the rest of the market just tanked, and pretty much everything was down. It was a broad-based downward move on Thursday. Semiconductors for the week had a good solid week. They were up 4.8%, and the mega caps were up 1.6%. These are the growth areas. This is the buy low, sell high things. These are the things that really help the indexes to go higher. We want those to continue if we're going to maintain more of a positive stance on the S&P. Tech also was up 3.4%. Communication was up a little bit, 0.3%. We want to see these areas doing quite well. Energy ended up being down, which that can go back and forth. Okay, right now, energy is more defensive because the reaction to energy, specifically oil, is geopolitical. There can be a time when oil is actually offensive, where it's going up because corporate profits are going up and the market's going up too. That's when it's more offensive. When it's good, when oil and things like this are really going up because of geopolitical events, that can end up being negative for the market. And real estate had a really rough week, down another 3.7%. Earnings reports and the economic reports that came out, they were kind of mixed. Some were taken as positive, some were negative. The 10-year yield closed at 4.46% and the dollar was up. Both of these together are pressuring stocks. So let's look at all the indexes. The Dow was down 2.3%. The NASDAQ was up 1.4%. The S&P was virtually unchanged, although up a little bit. And small caps, as represented by the Russell 2000, were down 1.2%. And I've been looking at this chart for about a year now because this is a very long-term chart and it really doesn't need to be updated. We're kind of in this area where I'm circling with the cursor right now with, for the most part, inflation still starting to come down. Now, we've been seeing it tick back up a little bit. The hope is, and the market's anticipating, that the current situation is going to follow what happened back in 1976 or so. Another reason for showing this chart is look what happened after that. No, we don't know if that's going to happen this time, but it happened before. And up until this point, this gold line here and the blue line have been fairly close to each other. So we want to at least respect what can happen. I'm not saying that is going to be what's happened or what will happen, but we just want to be aware. That's why I do the daily videos. We're able to see these incremental shifts and changes and see scenarios as they are developing. Instead of like in the weekly video, I just kind of tell you, well, this is what happened and this is what we're seeing, where we can kind of see this changing over a slower period of time on the daily videos. Anyway, I know people are busy and everything. Then we have this other research that I show every week where if we're at 4.02% or above with the 10-year yield, that's when it starts biting into corporate profits. Right now, we're at 4.46%, so we're above that level. Here's the poll results. Seasonally, June, July, and August can be strong for tech stocks and often helps the market go higher. Do you think that's what's going to happen this time? 83% said yes, 17% said no. And then the market is still extreme positive. Now, that's a week ago. We worked off a lot of those extreme positive conditions after Thursday. Do you feel that this will lead to a pullback or that it's showing good momentum? Actually, the bottom answer, chopped sideways, that's what ended up actually happening. And then I suppose I should have asked a different question. Only one person responded to this. And if you ever have any ideas for questions, send me an email. I'd rather you don't put it in the comments. You know, hey, why don't you ask everybody about should I buy NVIDIA? Okay, I'm not going to do that. All right, what do you think about Bitcoin? I don't do that. But if you want to talk about the S&P and the market in a more general sense, yeah, and you think you have a good question, let me know. I'll consider that. But we're watching utilities and staples, which are more defensive. This is what we saw at the end of 2021. The market was really getting into these areas, anticipating a decline. And if you were around in 2022, you know what a year that was. We're seeing a similar type of thing now. Okay, that's the negative side. On the other side, Jason Gepfert from sentimenttrader.com came out with some research and said, okay, it might be more negative in the short term, but when utilities and staples have been strong in the past, and he was able to count 12 times that happened, 10 out of those 12 times, we were positive 6 to 12 months down the line. Now, maybe the question, because that's too long of a time frame for some of you. Maybe that's why people didn't like this question. I was just going off the research that he posted there. All right, as of Friday, a week ago, stocks are at or near all-time highs. Do you feel that we've topped out? We will decline, or we're going to chop sideways? Actually, the 20%, that ended up being more correct for this time. All right, looking at earnings going forward, we're still seeing good projections off into the future. Looking at the truck tonnage index, we're seeing a bit more of a disconnect between them, where from 2009 all the way up till the COVID crash, these two were having a tendency to be not very far apart. and going in the same direction. Is this a concern? Just something to keep an eye on here. But this is a very long-term chart. It goes all the way back to 2002. The Magnificent Seven, I don't know. It's kind of been reduced to the big three now, or the dynamic duo or something like that. But it's still 31% of the market capitalization for the S&P. That's where the real movement comes from. I've started showing, I think I've got most of the Magnificent Seven. I might be leaving some out. Let's see, Apple, Amazon, I show that, Google, Meta, Microsoft, Nvidia, Tesla. I think I show all these. And this is where the real movement comes from. Well, we've got Apple in a downtrend, and Tesla's been under a lot of pressure. And a lot of these have been pulling back lately, and that's been pressuring the market a bit. But they're still the biggest part of the S&P. We're seeing some money going back into crypto now that we're going back up. Of course, people are chasing what's already happened there. And then looking at the S&P 500 and comparing it with gold, and all the gold people, like, they're just orgasmic right now, okay, with gold going up. But when you compare it to stocks, they're not really doing all that well. I mean, I'll show this in the intermarket analysis video where it is improving, but on a longer term chart like this, stocks are doing about the same as gold right now. Okay, looking at hedge funds and their exposure to cyclical. Now, cyclical, these are stocks that go up when the economy is going up. The buy low, sell high stocks. And then defensive, these are the things that folks get into when they're concerned about the market declining. Well, it shows that the exposure is that when you take one to the other, it's at an all-time low. That means a lot of the hedge funds out there are anticipating some kind of a decline. So now, hedge funds might be the big money, but they're not necessarily the smart money. But we still have to pay attention to them nonetheless. All right, FactSet just had one blog post this past week. We've got a real increase of companies that are talking about AI. It's all the buzzword. It's like, how do you spell AI? You know, that's how to confuse somebody. Like, when was the War of 1812? We're just seeing a lot of talk about AI. Now, AI itself, when we look at it as on the ETF, it's not doing all that great, but it's sure the buzzword these days. We have, what is that? Gemini for Google. We've got a new version of ChatGPT coming out, and it's just supposed to be amazing. So, yeah, a lot of people are talking about that. Here's our intraday chart. Going back to Monday, things were rather muted up until we had the Fed meeting minutes that were released. And there were some concerns about what's happening with the Fed balance sheet. And so we saw a bit of a drop after that. Then after the close, Nvidia came out with their earnings, and then pow, we just gapped way higher. Unfortunately, that was the high for the day. This was also an all-time intraday high, but we just went down. We tried to battle it out here. The battle was lost. We ended up tanking pretty severely that day. We did have a good day on Friday. We gapped up and were able to recoup and get back up into this crazy area where the market was already at before. So for the week, and this is just for the 5 trading days. This is not Friday to Friday. This is Monday through Friday. We had the NASDAQ and NASDAQ 100 up. All the other indexes were down. If you go from Monday through Friday, the S&P was actually down on the week. Going back to the beginning of the year, all of the indexes are positive. Looking at the sectors, and there's a couple of new columns in here. The first one is I go on the percent change. Tech had a good week, and that's what we want to see. If we want to get into growth, if we want to buy low and sell high, we want tech to do well, and we want communication to do well. We would like to see discretionary doing well, but it's just not right now. Then we look at a different way of analyzing the sectors. We go way over to the right-hand side and look at a scooter score. The higher the number, the better looking that particular sector. We have tech, utilities, which are still strong, and communication looking pretty good. Or we have real estate and discretionary looking pretty bad right now. Here's a relative rotation graph, and I compare this to the S&P 500 over the last year. And the longer this line is, it just means the more thrust that's happening. We have energy doing well in utilities. We also have the materials, which are falling back a little bit. We have industrials falling back a little bit. Financials have been doing okay, falling back a little bit. We're seeing where technology has been weak lately. Remember, this is over the last year, not just the last week or two or month or so. We've got real estate, and then down here is discretionary, and then healthcare. These are the weaker areas. Up and to the right is more positive. Down and to the left is more negative. Now, I wanted to include an additional chart here, just information bar chart. This also goes back over the last year and just shows us, okay, energy, utilities, industrials. They're the ones doing about the best. And here's the length of their tail. The longer the tail, the more momentum we're seeing over the last year. Then we get down in, we've got some neutral areas here. And then we get down into the negative. Real estate, discretionary, which we'd like to see doing better. Healthcare, which is also defensive. And we're keeping an eye on that. And then recently we're seeing tech showing some weakness. And this is compared to the S&P over the last year. And we look at the next one, and we're just going with the major market indexes, where we have the mid caps, which is still a stronger area. We have the OEX, which is the S&P 100. And I think somewhere buried in here is the S&P 500. We're seeing a little bit of recent weakness in the NASDAQ 100. Small caps still under pressure. The transports still under pressure. And with utilities and the Dow coming off of recent all-time highs, we're seeing a little bit more of an upward thrust here with the Dow Jones Composite Average. And here's a chart showing the S&P 100 right now over the last year compared to the broad market has been performing the best, followed by the mid caps and then the S&P. More neutral are the utilities and the Dow Jones Composite. We have transport, small caps, and the NASDAQ 100 showing some weakness. And again, this is compared to the Wilshire 5,000, a broad market index. So for the week, the different sectors, we had tech and communication up over the last 5 trading days. All of the other sectors were down. Going back to the beginning of the year, we have communication and tech are up. All of the other sectors are down year to date. Here's sentiment. We're getting more into neutral. Now, we want to look at the context for this. We were coming down. This is when we were dropping down in April and kind of bouncing around a little bit. We were turning more positive as we were going up. And then after Thursday, that just threw some cold water in the market's face. We really had some problems down here. So we're kind of more negative right now, but we saw a little bit of a tick up on Friday as far as sentiment. We're not getting any extreme readings right now because we're not seeing big enough moves yet. The active asset managers kind of getting extreme positive. Now, I was watching a video this week with somebody that I really respect. They read something into this that I don't see. I'll let you decide. Okay, as the S&P has been going up, we're making a lower high here as far as the active asset managers. Now, if we were looking at volume or an oscillator, I would totally agree. But this is a different measure in my view. This just shows me that we still have more room to run to the upside. I don't necessarily look for negative divergences compared to price here. You may differ, and that's totally cool. I don't when I'm analyzing how people feel. Then here's the same reading, 94.45, getting a pretty high reading currently. We saw a real decline in the VIX. We're getting very low readings, suggesting there's just not a lot of fear. Now, it came up a little bit on Thursday, but then it went right back down on Friday. The Ulster Index also showed a little bit of life this past week. Here's the spread between risky and not as risky bonds. We're going down, and that means the bond market is not seeing a lot of fear right now. To go with that, this is the same thing, but shown in a little different way. In the top, and I've been showing this a few times in the daily videos, this is the S&P on top, all right? Now, the chart that we just looked at right here, this is that same chart. It's shorter term, and I've inverted it. And so instead of going down, now it's going up to match what's happening with price. Here's the VIX, which usually goes down when stocks are going up. I inverted that also to kind of match all of these up with each other. And we're seeing more of a confirmation here. There's not a lot of fear as far as stocks. There's not a lot of fear when you look at the bond market this way. And we're coming off of recent all-time highs with the S&P. Okay, so things are looking pretty positive according to this. The latest reading from Investors Intelligence has us at 3.45. We're above 3. That's when we start to get a little nervous. But then we really get nervous if we get up into the 4s. The latest reading from the American Association of Individual Investors, and that's you and me, you know. We're in it. I've been a member of this thing for almost 30 years, I think. We're getting kind of a high reading now, but not necessarily an extreme positive reading. And we look at cash and compare it with the tech sector. When this is going down, that means tech is outperforming. Right in here where I'm circling was 2022. That's when we saw the black line going back up. We're still continuing to decline right now. Looking at the economy, GDP now, and we're going to get another reading on GDP, the second estimate this upcoming week. They're coming in at about 3.5%. Well, when you have a forecast, we're looking at just under 3% to the upside and about, 1.33% or so to the downside. This represents the same thing in bar format. We're mostly focusing on this latest bar, the one furthest on the right currently. GDP, according to Goldman Sachs, that's the gray blue area here, that they think we're going to come in at 3.4. And we've kind of already received this number here. And I say kinda because it's officially come out, but this can be modified well into the future. I remember back in 2005, I think it was, where, people were fit to be tied because they went back and were revising GDP from like the previous year and a half. And suddenly we found out that we were in a recession a lot longer than we had thought because it was revised down and it went negative. So these numbers are revised quite often. But the takeaway from this for right now anyway is that the forecast from Goldman Sachs and the consensus is that they're looking at GDP still positive. The Radex Bear Bull ratio, these poor folks. Now, this is after Thursday. And when we get a low reading, that means folks are thinking the market's going to go up. And we really tanked on Thursday. So when I get the next update of this chart, it's probably going to spike up because they tend to react to what's already happened. I mean, they have jobs, they have families, they have things they have to do. They can't sit around and watch the market all day. That's why they're in Radex Bear Bull funds. But because of that, they tend to see what happened and then make their decision based on that rather than anticipating what will happen. And so these folks get jacked around a lot. And all right. And then the national financial conditions were below the black line. That's positive. We don't have an updated version of this chart yet. We're still below the red line with the real-time summary rural recession indicator. And the smooth U.S. recession probabilities also still below the red line. That's okay for now. This is a quarterly report. We're coming down with the Brave Butters Kelly leading index. Inflation getting a little bit adjusted here. It's probably going to gyrate around a little bit when the report comes out this coming Friday with core PCE inflation. Here's the Fed. This is where we're at right now. The next meeting that they have is going to be on June 12th. 99.9% chance they're going to leave rates unchanged. And we're getting that more locked in. The dark blue is where we're at now. And then we go a day ago, a week ago, a month ago. Now we look out to the next meeting, July 31st. 88.9% chance that they'll leave rates unchanged at that meeting too. Right now, day ago, week ago, month ago. This is getting more locked in than what we were seeing before. Now we're starting to look out into September. This is where we see the probabilities change a little bit here. 50.2% say they're going to leave rates unchanged. 44.9% think we're going to get a 25 basis point cut. 4.5% think that we're going to get a 50 basis point cut. And way over here on the right, there's 0.5% of people that think there's actually going to be a rate increase at that meeting. Now, this is way off. This is like, science fiction future, according to where the market's at right now, because this can change and go all over the place quickly. We just want to keep an eye on this just to see what the market's thinking as of right now. And this is how it's changed. And we're seeing this settling around this anywhere from unchanged to a 25 basis point cut. And that's why in the daily videos, I say that the market's looking at September. That's because there's a pretty good percentage of the market that thinks that's what's going to happen. But that's going to change. Here's the Fed balance sheet, which has been decreasing, although we did see a little bit of an increase. The Fed has come in and announced that they're lessening quantitative tapering. You could kind of switch that around and interpret it as quantitative easing, and the market liked that. And that was one reason we came up out of the lows in late April. There's another look just showing how it's still decreasing overall. when we look at this on a year-over-year basis. Looking at the advanced decline line, we're still looking pretty good longer term based on price and volume. We're still looking good on the daily chart too, but that isn't really breaking down yet. We're seeing a little bit of a breakdown with new highs minus the new lows. And it's not that new lows are expanding, it's that new highs are contracting. So we're coming down with the new highs. We're still looking positive here with the 4-week, but we're turning down a little bit, and we're starting to flatten out with the 10-week. And it's more of a slowdown in new highs rather than a pickup in new lows. That's what I'm seeing right here, right now. The advanced decline ratio. We went negative after Thursday with the blue line. We're back to positive now. On the weekly chart here, we're positive with both. The accumulation distribution. We're looking good on the daily chart. That's being confirmed here by what we're seeing on the weekly chart. Here's our trend, where we are below the moving average. It's trying to turn back up, but it hasn't crossed. The black line is the ADX. When it goes below the moving average, my definition is that's a weakening trend. And then we go all the way down to 20. That means we're in a non-trending environment. Then we look at the green line and the red line. Whichever one is on top, that's what we default to. The green line is still on top, even though it ticked down a little bit here. So we would still default to positive. We're still in a trending environment, but it's a weakening trend until we cross back above the moving average. Arun. We're still looking extreme positive here. The green line's on top, that's buyers. The red line's on the bottom, that's sellers. The oscillator down in the middle, that's the calculation between the red line and the green line. When we're above zero, that's positive, and we're pegged at the top right now. Mass index, and we were talking about a daily mass index signal. I never really seemed to, I mean, we went up, but the mass index was suggesting that we were going to go down. And I've stopped talking about that chart in the daily videos, and we're not getting a signal here. Looking at the daily chart, not really seeing anything as far as overhead resistance on this chart. If we start to fall, we have a pivot level. We have the 50-day moving average. And you can see, and this is a daily chart, where we've been below average. Even with the big red part that you see right here, that was Thursday, and that just came back up to average. We are still looking positive, though, according to the Keller market model in the short, intermediate, and long term across the S&P, mid caps, small caps, and NASDAQ 100. Still looking more negative in the intermediate to long term with the price of bonds. That means longer term interest rates are still going up, but bonds in the short term are now in an uptrend. Commodities are seeing a full across the board uptrend now, and we're seeing some recent weakness on a short term basis with the US dollar index. The decision point scorecard, it was changed, but it was many days after this date that you see down here. We're positive in the short term, positive in the intermediate term, and mixed in the long term according to how they measure things. The trend channel is still positive longer term. I haven't had to show this chart. I feel like I've been on vacation, my gosh, because I've been just hammering on this chart for most of 2024, because I was talking about it as we were even coming up to this line in the first place. Then we got above it, then we fell below it, now we're above it. Well, we're a couple hundred points away from it now, so at least I get a break. We'll see if that comes back into play. We're still positive with our 50-period simple moving average study. We're positive with our moving average crossover way of measuring trend. We're coming down and looking a little more negative here. We dropped below zero with the McClellan oscillator, but we're still looking okay with the summation index based on price. We came down a little bit, but we're still positive based on volume longer term. We're actually turning more negative with both of these charts on the daily versions. We look at the Swenlin trading oscillator. This is negative on the daily charts. It's also looking more negative now based on price because we dropped below zero, and we're also looking more negative based on volume. This is a warning sign that we've been watching for about the last week. Bullish percent index. Now, this is something that's been holding up quite well. We came almost up to 70 and pulled back a little bit, but we're still doing okay for right now. If we can turn and go back up, that'll be more positive. If we fall, that would be more negative. This is actually going to be officially negative if we end up dropping below 50. And then looking at our momentum, still having a hard time here with the PMO. We're coming back up slightly based on price and volume. But when we look at the studies inside of the PMO, we're declining with the rising PMOs. We're declining with the buy signals, and we're starting to flatten out with the PMOs above zero. We're also seeing some weakness here on the daily charts. The percent B indicator is not really telling us anything other than we're above the midpoint, and that's positive. Here are all the oscillators. We're going down with the slope. We're going down with the TSI. These are shorter term. We're trying to turn back up with the MACD. We're still kind of on the moving average with the PMO, turning up a little bit with the PPO, where we're still declining with the tricks in the KST, which are longer term. We're kind of seeing a similar, well, not on the daily chart. The slope oscillator is crossed below its moving average. All of the other oscillators are rolling over, but are still positive. We're still going up with the longer term oscillators on the daily chart. Chicken money flow, still looking good here, seeing a little bit of weakness on the daily chart, but both are still positive. The chicken oscillator is going up and above zero. That's positive and holding up okay, positive on the daily chart. The force index is positive on the daily chart and here on the weekly chart, even though it declined slightly. The money flow looking good on the daily chart, also still looking positive here, even though it did decline. Rate of change, we're virtually unchanged on the week. Over the last 50 weeks, we are still looking pretty good from a momentum basis, but we're above this red line. And sometimes when we get around this area, that might mark some kind of a top, but we could still go higher than where we're at right now. The RSI coming back up, but was flat this past week, but it's still positive longer term. The daily special K, or excuse me, the weekly special K chart just will not turn positive. We've been looking really good since the latter part of 2022, but it's still negative. It crossed over last summer negative when we had that downturn, and it's like, I'm scared. I don't want to come back and be positive, where the daily chart is still positive. The Stochk RSI is above the midpoint, so that's positive there. We're still extreme positive with the Williams percent R. We're above 50 with the ultimate oscillator. That's positive. The vortex is going back up at the green line. That's positive. And the Copic curve, still negative here, where we're positive on the daily chart, but starting to roll over. And here's the weekly kind of support areas. Since we're well above those, this really isn't in play currently. We are still declining with our long-term equity put-call ratio based on 253 periods. Why 253? Well, it used to be the area code where I lived, but most of the time there are 253 trading days in a year, and that's why. Then looking at the VIX and taking a 3-month average of the VIX, this is declining, which often is positive. On a trending basis, we're looking a little more negative on some of our daily charts, but we're still looking good here with the Heikin Ashi on the weekly chart. The Kegi chart is positive. The Renko, it's redrew a little bit here, but it's still looking positive. And the 3-line break still looking a little bit negative, but we still would lean towards the positive side. The ease of movement is still above zero and going up, and it's positive on the daily chart as well. The point and figure, no new X's were drawn here. We saw one on the daily chart when we set the all-time high, but it wasn't enough to really generate anything on the weekly chart. And we have a double top breakout. Now, the signal that we see on the daily version was generated on May 15th. Same signal, double top breakout, but this was generated on May 13th. Looking at our momentum, longer term, still looking okay here, going up to sideways in the intermediate term, seeing some declines, but still positive in the short term. I don't know if this is coming up or not. I have this little tool, the inspect tool, where I go over and it tells me what the date is, but this can change because this is a long-term chart, according to the tools that I use. It could be June 4th when we're getting the next 50-day cycle turn. I don't make decisions based on this, but sometimes you can see where it was kind of accurate. Other times it marked a bottom. Other times really didn't tell us much at all. Then about a week ago, I was watching a video from a perma bear who was just giddy and took 40 minutes to explain what I'm going to tell you in 15 seconds. We look at a 197-day cycle. And if you go back, this was the high in late 2021. This was the low in 2022. This was the high that we hit last summer. And then here's where we're at right now. Well, we just missed that cycle day by a week. So not sure if there's anything here or not. We're still looking positive with the Elder's Impulse System for the S&P. We're still looking positive on the daily chart. Now, we have 2 days of dots on top on the daily chart. To me, that's a pretty big signal. Now, we can get that back, but it's going to take some real upward thrust for the S&P to turn back negative on the daily charts. But we're still positive here on the weekly charts. Then looking at seasonality, May, we're up. When you go from 2020 to 2024, we've been up 100% of those years, last, 5 years. and we get a return of 2.1% for the month. Looking at just the indexes, where we have the S&P setting recent all-time highs, the mid caps not an all-time high yet, and the small caps continue to chop sideways and are currently range bound for all of 2024. Looking at the Dow, we are back down to this blue line here, which is a 13-week moving average, but we're still in an uptrend. The NASDAQ setting a new all-time high and in an uptrend. NASDAQ 100 setting an all-time high and in an uptrend. Here's another weekly look at the QQQs, also coming off of an all-time high on a closing basis. The mid caps are doing okay now, but have not gone back and set a new all-time high. The small caps, as I said, are just range bound for 2024. The NYSE seeing a bit of a pullback this week, but still in an uptrend. The Wilshire, now this is a daily chart. This is still looking pretty solid. Another broad market measure. All stocks ticked down a bit for the week, but still in an uptrend. The 30 biggest software companies. This has been a little area of disappointment. We're not seeing the big upward thrust that we were seeing before and that we're seeing in other areas of the market. The FANG index setting all-time highs. ARC also just kind of arcing around in a flood, so to speak, just bouncing up and down right now. The banks still hanging in there for right now. We're above 50 with the RSI, but coming down, and we're trying to maintain positive momentum. And these are the deposits. This above the black line just means that folks are willing to put money back into banks, and that's more of a sign of confidence. Here's just a blanket chart of Dow theory coming off of recent all-time highs. We've had the utilities. Now, they've got a ways to go to get back to all-time highs here, but they've just been on a tear lately where the transports have just been running out of gas. Yeah, that's supposed to be a joke. Looking at the broad markets, the CRB index still in an uptrend on the weekly chart. Oil has been dropping back down and staying below 80, but it's not really falling necessarily. Copper is off of its highs, but still has just been going up. The dollar still in an uptrend as well, even though it was up slightly on the week, but we're seeing more short-term weakness on the daily chart. Gold just kind of bouncing around here now, but still in an uptrend. Silver has been doing actually a little bit better, but man, these are volatile things. Even the ETFs bounce all over. Keeping an eye on the price of bonds, we're still in an uptrend and showing some improvement. Now, if bonds go up, that means that interest rates go down. Monthly chart, stocks continue to outperform bonds. We're looking at the 1 month and subtracting the 3 month. We're getting a negative result, and that's what it should be. When we go through weird periods like the debt ceiling crisis or something really weird happens, that's when we see this thing start looking like an EKG going all over the place. Here's a daily chart of yields, just showing how lately they have been coming down for the most part. Here's a weekly chart where we were up with the US and UK rates and German rates, and we're seeing a tick up in Japanese rates. Relative studies. First, we look at intermarket analysis, where gold and oil are tied for the lead, followed by stocks, and then the dollar and bonds are negative based on price. Ratio from the NASDAQ 100 to the S&P 500, holding up. It came down and was showing some weakness. It could be starting to improve now. S&P 100 is outperforming the S&P 500. Growth to value also showing some improvement just this past week. This is an area that we've been concerned about. To see this going up is encouraging. Gold to the S&P, this is where I talk about. You know, they're not really, one's not really outperforming the other currently. And gold to the dollar, it's outperforming the dollar a bit, but lately has been falling back when we compare the two. Bonds continue to underperform stocks on a longer-term basis. The low volatility to S&P ratio continues to go down, and that's more positive. Folks get into low volatility stocks when they're more defensive. That's one area that we're not necessarily seeing an improvement in, which is comforting to us if we're more positive on the market. Discretionary to staples. We want to see this doing better. It's not. In fact, we're seeing a death cross here with this ratio. Energy to tech. Again, we're pulling back with energy right now as tech has been doing a little bit better. Longer term energy has been underperforming, but this is kind of when things started to happen again in Israel, and we started to see the energy sector going up, and we also saw oil going up. Then longer term with our trend studies here, we're still working off of that signal that was generated in October of 2022. Here's the ZWAG NYSE breadth thrust. We were 1 day late generating a signal, and now this is really falling back. But we wonder, was it close enough? It didn't give us an official signal like it did previously, but we were 1 day late, according to how I calculate it. We have the Zohorchak method, which is still on a full-on buy signal. That's long-term positive. Longer term with our weekly S&P chart, we're still looking okay there. This is a blow up of that same chart. We're still hanging in there that way. We're still looking good when we take the NYSE new highs minus the new lows and then a 50-period moving average of that. When this is going up, that's more positive for the broad market. Then we look at that same type of thing, but just apply it to the S&P. This is also going up, even though it ticked down just slightly recently. Here's the NASDAQ 100. We're still looking good with the longer-term trend there as well. This is the NASDAQ 100 to Dow ratio. And I don't know what the perma bears are going to do about this, because they're like, ooh, look at this, we're here. Ooh, look at this, we're here. Ooh, look at this, we're here. Well, now we're breaking above that. What are they going to say about that? They thought that this was overhead resistance and we were going to hit this and then just go down forever after that. Well, we're actually going up. Here's another similar chart, also showing a lot of improvement. We're above this blue line now. According to them, we should be going down. We're still going up. Here's another newer one. We're coming right back up to this blue line, and oh man, they were salivating like you would not believe. We hit this blue line and started to come down, and they just declared the end of the stock market as we know it. Well, since then, we've been going back up. We look at the NASDAQ new highs minus the new lows. On a cumulative basis, we're still kind of chopping around right now. This is longer term. And then we want to keep an eye on the 3-month yield. It's going sideways for the time being. If it really starts to fall, that's when something bad might be happening. Seasonality. We do have some positive seasonality. Let me try to say that again. We do have some positive seasonality coming in at the latter part of May and then going into June. This is Dan Bird's chart that he made available. We're also looking good here when we compare 1982 to 2023. And even though this isn't filled in, this is kind of what's been happening since then. And you can see what things did after that is back in 1982 going forward. May tends to be strong on a winning percentage, up 13 out of 18 times, down 5 out of 18 times. But the return is not very good if we go back to 1950 and count the election years. Here's May also. According to this, we're a little bit more positive. We get about a 1% return here. May is also okay, where April should have been a lot stronger, and then we saw a lot of weakness. So that's why we just use seasonality as a guide. But this is looking at the whole world in our hands. Okay, and then we see some downward movement here going into the end of May. And that we're not really seeing that. But then we see positive seasonality in June, July, and August. Now, I kind of marked this up a little bit. I had been focusing on the first half of May here where we tend to see weakness. Here's the second half of May where we tend to see some strength. We still have 1 week left with some positive seasonality working for us. And then according to Carson, we're up 77.8% of the time with a 2.3% return when you jumble the numbers around and look at it this way. But when you look at it from May through October, this is the worst performing 6 months that we see. But over the last 10 years, we have been up 90% of the time with a median return of 1.1%. Then we look ahead a little bit. June, July, and August, for tech anyway, tend to be positively seasonally positive during election years. We're also seeing a confirmation of that with the Stock Traders Almanac chart. Also seeing some positive seasonality in June, July, and August here, according to this other Carson chart. And then here's another one, which also sees some positive seasonality going forward. And another one, which takes June through August. And this is when we see some strength in the market. Now, there's no guarantee. There could be a black swan event that comes in and hits the economy or the U.S. or something crazy could happen. But all we can do here is go with what's already happened and use that as a guide, and then watch it be either confirmed or not confirmed on a day-by-day basis. And if you can only watch the weekly videos, then a week-by-week basis. Now, we have another thing, and oh boy, the Perma Bears are partying this weekend. There's this thing called the Hindenburg Omen. If you're familiar with history, it was a blimp that blew up, and yeah, in one of Led Zeppelin's albums, they've got a picture of that, and all the humanity and all that stuff. Well, I used to just throw this off as a non-event because it was only the Perma Bears that would bring this up. And then I did a little bit of research myself, and I'm like, okay, I'll kind of pay attention to this. Here's the chart. We had the first part of a Hindenburg Omen signal generated this week. It was actually after Thursday. No, after Friday. Okay. And you can bet I don't read any of this stuff. I haven't had a chance to watch any of the other videos, but these guys are just, this is like Christmas, New Year's, birthdays, everything all rolled into one for these Perma Bears. Here's what has to happen. We have one spike up. We have to see another spike up within 20 trading days, which is roughly a month. There's roughly 20 trading days each month. So this is a non-confirmed signal right now. Okay, I'm going to go to the next slide because this explains the Hindenburg Omen, and this is all the parts that make it up. Okay, I'm going to go back to the previous slide. The indicator that I have here takes all these things, this crazy stuff that you read here, and puts it into one indicator. That's a cool thing that stockcharts.com did. So we don't have to crunch all these numbers. We can just look at a chart. But if you want to learn a little bit more about this, please feel free to pause this video and look at that. Thank you. I really want to wish everybody a very happy Memorial Day and a Memorial Day weekend. Have a great time doing whatever you do. Stay safe, and I will talk to you in the next video.